All right, again, welcome to this new video, a topic that I absolutely enjoy, which is returns on investment. I want to make sure that you understand that this video does not tell you why it is great to invest in South Florida. I mean, there's many reasons why to invest in South Florida, especially because of the appreciation between 7 and 10% for the last 10 years. And that is a unique market. And because we are in a unique market, I can tell you many other benefits. But right now, we're going to talk a little bit about market predictability. And the main reason of market predictability in real estate is because you can always estimate the income and based on historical data. You can go into all the historical data and find out what the property is actually worth, what they sold. A 3.2 in a particular neighborhood should sell very similar to another 3.2 in that particular area if you do exactly the same thing. And it would also rent for the same amount. So you might have a 2.2 condo or a, whatever, bedroom, bathroom count, and it will give you specifically the same property. The difference between a change in rental income on a particular building, and another unit within the same building is minimal. I mean, usually it's not that big. As a matter of fact, when we find it, we'll put it as an outlier. But that's one of the good things. And then you have the projections. If you know that has been the rental income for X amount of years, you can kind of project the same value in the next few years, 1 or 2 years. You can say confidently, with a certain amount of confidence, that particular rate will be the one that you can collect in the next year or two. So that is on the part of the income. Okay. Now the other part is on market predictability. It's on the expense part. On the expense part, you have usually a fixed rate financing. And when you have a fixed rate financing, what are you actually doing? Well, you have a set payment that will not change at all. What's the only thing that actually changes is taxes and insurance. And perhaps if you have it in a condo or something like that, where you have an association, the association fee might change a bit. Okay. But that is the only thing that will change. And even though, even those two items, the taxes and the insurance, they have certain predictability because they need to be amongst a particular range. So those are not going to go up or, they never come down, but they're not going to go up in a very strange way, in a very radical way, like 20 or 30%. Usually that's not the case unless, you have like a hurricane coming or something like that. There's something huge, but that has not happened. Very few times actually does, but it's kind of predictable. That's basically my point. Of course, there's some other things that you need to keep money for in order to make your property predictable and make it profitable at all times, and that is vacancies. You need to follow the market to know that you are renting at a proper rental rate, so you don't keep the property vacant for too long. Okay, then you have the maintenance. Things are going to go bad. They're going to break. So because they will break, you need to have money accounted for that particular reason to fix them. Okay, and that account will top at some point. I mean, there's, if things are actually happening and, you don't need to put more money into it, that's it. But you must have that particular money so you don't have an emergency at any point in time. And then, of course, you can manage the property yourself, or you can have somebody else manage the property for you. And whatever the costs are, you can put them together and make sure that you are in that they're predictable, that you know exactly what they are, and you can have it very predictable. So let's talk about return on investment. There's a big conversation about returns on investment, especially when you're buying real estate, because you have like two big buckets. Imagine that you have two big buckets. The number one budget is the cash flow. The number two budget is appreciation. There's a big difference between one and the other. And let's dive in on the cash flow. All right. So on the cash flow, we already talked about that you have a particular rental rate increment historically in the area. Therefore, you kind of know where the rents are going to go. At some point, they might come down, they flatten a little bit, they will keep going up. But the government is always following the inflation rate. So the rental income usually is steady. You will see where you're actually going on according to history. History tells us that the interest rate goes up a little bit and a little bit. Why? Because things are actually more expensive. You got the inflation rate. The government follows the inflation rate closely because they don't want to have too much inflation, but they don't want to have none inflation. Why? Because things are not progressing when you have no inflation, and things are hurting and people are hurt when inflation is too high. So they want to have it in that sweet spot, which is right around 2.5%. So that is what they want. So you can predict that somehow your rentals will actually go up. If not, imagine how much you were paying in rent 5 years ago, or how much you were collecting on a particular property, investment property 5 years ago. All right. Now the expenses on a particular property are very fixed. You got, first of all, we already talked about the fixed mortgage. If you have right now a property, you must have it mortgaged anywhere between 50 to 70% of its value. That is the best way to have it. That is the most effective way to own real estate, is to have it mortgaged always. And we can do that calculation left and right many times, and it is not good to put all your money. Some people that insist on that, that is okay. That's a very safe way to do it. However, we do not recommend it, okay? Also, you have predictable tax rates. Tax rates do not usually increase any more than 2-3% unless you're recently buying the property from a homesteaded, owner-occupied seller. But other than that, they usually are very predictable. They're not like, you don't get a huge spike on that. The same thing with insurance. Insurance shouldn't be that high unless something critical happens, but it should be in a very good predictability range. Let's call it that way. And as long as you have all your reserves or maintenance, you can also have historical data. You know exactly how old the appliances are, the roofs is, and everything in your property. So that would be another way to follow up on what your expenses are. And that's why if you have the income ready and predictable, and you have your expenses ready and predictable, where's the catch? I mean, that's it. Where's the catch? And you have your reserves account. There's really, in cash flow, you should not have a catch at all because they are predictable. And that is my point. Now, notes to cash flow. I want you to know the rentals 99% of the time increase. I mean, I always say you should increase your rental, even $10, $20, or $30. So you remind the tenant that things actually cost more, and they do, because taxes will increase a little bit, but they will increase. There's so insurance, so all of that. Okay, you always want to maintain your reserves. The reserves are going to reach a point that you don't need to keep any more money, so you can grab that money. As it is okay as long as you have enough money to cover for anything unexpected. Okay, many times you have money for everything. Very seldom you have money when three things break at the same time. Okay, but anyway, and then the other things, you always want to have stable tenants. Of course, try to maintain stable tenants. You achieve that by pre-screening and making sure that you do a very good screening at the beginning. Of course, you may have somebody, that particular person that has a very good stable job, and then all of a sudden, gets divorced, somebody dies in their family, or, all of a sudden the company what they work for is sold and they out of a job or something. Those things actually happen, but it is very seldom, very often you keep a good tenant and you want to keep them for a good time, okay? But always increase that little bit of the rate every single month. Taxes and insurance, again, they usually have their increments, and make sure that you pass that along to the tenants, okay? So we're going to talk, the second part that we're going to be talking about is appreciation. The appreciation, of course, you have two big buckets in the appreciation. The big appreciation, the biggest perhaps, it's going to be the market appreciation. Imagine that you're in a bus. Everybody's in the bus, and the bus is going to a particular place, and everybody will arrive there. That is your 2-3% annually. Historically in the United States, that is the 7 to 10% in Miami that you're actually getting. People often ask me how long that's gonna last, and I can tell you that we have another video specifically for that. Why? Because there are many particular specific reasons why Miami should be increasing in similar rates for the next at least for the next 3 to 5 years. Okay, but that's a topic for another video. Now, the market rate is what I'm telling you is where everybody is. Even if you buy at market value, you will have a property 2 or 3 years down the road. At least it's gonna cost more in the same percentage of that of inflation. Okay, and then on the other side, you have what is called forced appreciation. The forced appreciation is the one that you, as the word says, you force it. How you force it? Well, you can do things to increase that appreciation. There are some things that you can do to the property in order for you to increase the value. Many things you can do, and the first thing is you can buy distressed properties. When you buy distressed properties, of course, you're going to get them at a discount. The distress may be in a form of property updates, deferred maintenance. The roof hasn't been done for a while. Different things to the property have not been done. They have not been updated. You still have a 70s kitchen or something like that, and you want to update it. Most of the buyers do not want to walk into a property where they need to start working on it. They're buying a property because they want to be work-free. They don't want to start working again. So the cost of fixing a kitchen is more than the cost of actually fixing it. And what I mean by that is that if the cost of a kitchen is $20,000, usually the buyer sees more than the $20,000 because you have all the disturbs, all the things that happen by fixing it. You're actually fixing your property. You have the inconvenience, you have the dust, you have the workers, and that is something that most of the buyers didn't want to go through. So this is what I mean, that it actually costs more than 20. So when you're buying a property that is in distress, the property costs $20,000, but you can account for 30, and that's usually the case. And the seller will be okay with that because they do understand that particular point. So, deferred maintenance improvement, it's another one. And then you have property improvements. You can actually expand on a house that is very small, and that is very, very nice. And that is where you start getting into the big ticket items and big money. You can increase the ceiling, make it higher. You can add square footage. You can add a terrace. You can add a pool. You can add a garage. Different things like that will rapidly make more money to your property, and that is what I call forced appreciation. And of course, The biggest one is when you change zoning, when you change the use of a particular property. That takes a little bit of knowledge, of course. It's going to take also time, anywhere between 6 months to 2 years or so in some cases, depending on what you encounter. But it is a money-making item. Okay, when you do that. Now, also on the appreciation, I do understand some notes on this appreciation item is I do understand that the only way for you to acquire and realize that appreciation is by cashing out or selling. And I understand that. Well, there's nothing wrong with cashing out because you pay no taxes on it. And if you have the property rented, the tenant will pay that mortgage. So you're actually not paying it. So it's pretty nice to receive at some point $150,000, $200,000 from a cash refi after you do all these fixes and you rent it at a market value, you make that money. Keep in mind that is free money. You pay no taxes on that. Of course, on refinancing, the only thing that you need to make sure is that you are refinancing and the tenant has the money to cover that payment. So if it is within the price range, the rental rate, then you're doing okay. And then of course you have the tax benefits of depreciation. All right, so of course you have the big ticket item is depreciation. Why? Because in depreciation you can actually deduct money from the government, from the money that you pay the government, that particular item. That is awesome, specifically because that doesn't mean that you are taking money out of your bank account. So the accounting part on the depreciation is something different than the money that you end up with on your in your bank. Okay, and the last one and the biggest one, perhaps I would say, is the 1031 exchange or the deferred capital gains. If you make $200,000 in this property, one, and then you want to invest it in property two, you can defer those $200,000 to property two. And if you want to do it again after you do it in property two to go to property three, you keep on doing as many times as you want. Just got to keep track of all those numbers. You got to have a good accountant. You got to have good numbers and, make sure that you have everything documented, and you can do it many times. And of course, consult with your CPA for that particular strategy, which is a money-making strategy. So we talked about total return. Again, total return is equal to the cash flow that you make on a particular property, which is 100% predictable. Okay, 99.9% predictable. Let me repeat correct myself. And the other part is the appreciation. It's what you do when you have the property. Once you buy it, I'd kept properties for a while and then improve upon, increase the rent, and then now I have the money to pay for all the improvements. Or you can probably buy them outright and improve them and have that. Or you can buy a beautiful property that simply cash flows. Okay, but that is specifically how you actually get to the return on investment, which is one of the questions that most of the people ask because they want to know exactly where the money actually comes from. If you want to follow us, if you want to know more about any particular detail in real estate, you can write us, you can reach out to us. We want to be your real estate resource of choice because we've been doing that. We've been doing real estate for the last 28 years. We have a little bit of investment. One of the things that I have on my retirement is in real estate. And keep in mind, don't wait to buy real estate and wait. Thank you.